Welcome back to Investing Talk podcast. Today we're taking a deep dive into a company that operates in a really distinct space, CoreCivic. We've pulled together some material to help us dig into their recent financial performance, understand their unique business model, and get a sense of the industry landscape they navigate. Our goal: to unpack what's truly important here, maybe beyond just the headlines, and figure out the key takeaways for you. And hey, before we jump in, if you find this exploration valuable, please do us a favor and take a moment to subscribe, like this episode, and maybe leave a comment with your thoughts or questions below. It really helps us figure out what to tackle next.
Absolutely. It's definitely a company that sits right at the complex intersection of finance and, well, public policy. That always makes for a fascinating analysis, doesn't it?
It really does.
We'll focus on what the recent data seems to reveal.
Okay, let's start at the beginning then. For anyone who might not be familiar, what exactly is CoreCivic? The description we have calls them a diversified government solutions company. What does that actually mean, like in practice?
Well, at its core, CoreCivic provides services primarily in corrections and detention. Basically, they manage facilities under contract with various government agencies.
Okay.
This includes federal partners like U.S. Immigration and Customs Enforcement, ICE.
Right, ICE.
As well as numerous state and local governments. And their services, they actually extend beyond just running the facilities. They include things like reentry programs too, sort of aiming to help individuals transition back into society.
Ah, okay.
So yes, diversified government solutions kind of means they partner with governments to manage infrastructure and provide these services related to the correctional and detention systems.
So they essentially run the physical spaces, provide the necessary services, but they do it for the government under specific agreements. It's a contract-based relationship, really at the heart of it all.
That's the key. It's all about those contracts.
Exactly. Now, the material really highlights their recent performance, specifically the first quarter of 2025. So let's unpack those numbers. What were the sort of headline figures?
The first quarter of 2025 showed some significant strength. Total revenue came in at $488.6 million.
Wow, $488.6 million.
And what's notable about that figure is that it actually exceeded expectations. Analysts had been forecasting something a bit lower, closer to $477.9 million.
Okay, so a decent beat on revenue.
Yes. And net income for the quarter was $25.1 million.
Okay, so revenue beat expectations by a solid margin. What about profitability on per share basis? That's often the key metric investors are looking at.
Right. The diluted earnings per share, or EPS, for Q1 2025 was $0.23. Now, this figure is quite significant because it substantially beat the consensus forecasts, which were way down around 12 cents.
12 cents, wow. So 23 cents is a huge beat then.
It really is. And it also represents an improvement from their Q3 2024 EPS, which was 19 cents. Beating estimates to that degree, it suggests the quarter was, much stronger than many anticipated.
Yeah, no kidding. That's a pretty considerable beat on EPS. Beyond net income and EPS, were there other key financial indicators that sort of stood out in that quarter?
Yes, definitely. Looking at other measures of profitability often gives you a clearer operational picture. EBITDA, which, stands for earnings before interest, taxes, depreciation, amortization.
Right.
That was $81.0 million for Q1 2025.
Okay.
And another important metric, particularly for companies with significant real estate assets like CoreCivic, is funds from operations, or FFO.
FFO, right.
FFO per diluted share for the quarter was $0.45. These metrics, they often strip out non-cash charges like depreciation, so they give you a different view of the cash-generating potential from operations.
Got it. So EBITDA looks at core operational profit, sort of before all the accounting and financing stuff, and FFO gives that real estate specific view of cash flow. Did the company make any moves with its own stock during that period, like buybacks?
They did, actually. The company repurchased shares. They spent $37.9 million to buy back about 1.9 million shares.
Yeah.
Share buybacks, they can often signal that management maybe believes the stock is undervalued, or it can just be a way to return value to shareholders by, reducing the number of outstanding shares. Helps boost EPS sometimes, too.
Right, take shares off the market. And I think I saw mention of an operational metric that improved as well is occupancy rates. That sounds like it would directly impact their revenue.
It absolutely does. Occupancy rate is, well, it's crucial for a company managing facilities like this. In Q1 2025, their average occupancy rate increased to 77.0%.
77%. Okay.
And that's up from 75.2% in the same quarter of the previous year, 2024.
So a noticeable increase year over year.
Definitely. Higher occupancy means more beds are filled and utilized under their contracts, which, directly translates into higher revenue potential. Think of it like a hotel.
More rooms filled, more money.
Pretty much.
Uh,
For CoreCivic, increased occupancy in their facilities, that drives income.
So putting all those Q1 2025 numbers together, you've got higher revenue beating expectations, significantly stronger EPS than forecast, solid EBITDA and FFO, share buybacks, maybe signaling confidence, and importantly, improving occupancy rates. It paints a picture of a pretty positive start to the year, financially speaking.
That sums it up well. A strong quarter by these metrics.
Okay, so beyond these recent financials, what defines CoreCivic's business and its place in the industry? Right. What gives them their competitive position?
Well, a key factor noted is just their sheer size, their large network of facilities. Having that broad geographical footprint and a diverse portfolio of different types of facilities, correctional, detention, reentry centers, it provides a significant operational advantage.
Well, scale helps.
And they can often offer solutions tailored to specific government needs across different locations because of that scale.
And were there any specific, operational updates mentioned that contribute to this edge? Things they're actively doing?
Yes, some strategic operational updates, like reactivating certain immigration processing centers, are noted as contributing to their advantage. Expanding their transportation fleets is another operational move that can enhance their service offerings and maybe their efficiency, too.
So they're not just sitting on the assets, they're actively managing them.
Seems that way. It's not just static facilities. There's active management and strategic deployment involved.
Who are their main competitors in this rather specialized space? It's not like there are hundreds of these companies.
No, it's fairly concentrated. The material names GEO Group and Management and Training Corporation, or MTC, as the primary competitors.
GEO Group and MTC.
Okay. And CoreCivic is positioned as a significant player within that group. What sort of distinguishes them, based on this info, is partly their focus on innovation, particularly in those reentry services we mentioned.
Ah, the reentry program.
And also their emphasis on cost management, trying to provide competitive solutions to governments.
So it's not just about managing the buildings, it's also about the services inside and being, cost effective.
Yeah.
What are the broader trends or the major factors influencing this industry as a whole?
As we kind of touched on, growth drivers for CoreCivic include that increased facility utilization ties back to the occupancy rates and these strategic operational moves. However, and this is a big however, the material makes it very clear that this sector is extremely sensitive to government policies.
Mm-hmm.
The ability to secure new contracts and, critically, to renew the existing ones is just fundamental to their business stability and growth. Their customer base is almost entirely government entities.
Right, their only customer, really.
Pretty much, which makes them highly dependent on government funding priorities, policy shifts, procurement processes, you name it.
That dependence really does highlight the unique nature of this business model compared to, say, a software company or something. Their fate is just very directly tied to government decisions.
It is. That's the core dynamic.
And speaking of government, that reliance on contracts is also highlighted as a major risk, isn't it? It's kind of a double-edged sword.
Absolutely. It's perhaps the most significant external risk factor they face. Any regulatory changes affecting the use of private facilities by federal, state, or local governments could substantially impact their operations, their revenue, their overall profitability.
So a change in administration or policy.
Exactly. Changes in administration priorities, new legislation, or even just specific government agency directives can pose a real challenge.
And there's also that factor related to public opinion, correct? I saw that mentioned.
Yes, that's definitely noted. Public perception and ethical concerns surrounding the private corrections and detention industry are seen as significant challenges.
And that's not just noise, right? That can have real impact.
It can. This isn't just about abstract opinion. Negative public sentiment can translate into political pressure on governments, potentially leading to policy changes or decisions not to renew contracts down the line. It's a factor that really influences the environment they operate in.
So you have this picture of solid recent financial performance, but it's sitting right next to these considerable external risks tied to policy, regulation, and public sentiment. How do contract dynamics play out in that kind of environment? Were there recent contract updates mentioned? wins or losses?
The material does point to some recent contract activity, yes. They announced some new contract modifications to add capacity for ICE, which kind of ties into that increased occupancy theme we saw.
Okay, so positive there.
And they also secured a new management contract with the state of Montana. So some wins. However, it's also important to remember the business has seen impacts from contracts ending in the past. Things like a lease with the California Department of Corrections ending, or an ICE contract at a facility down in South Texas.
Right. It just reinforces that securing and maintaining contracts is this ongoing process. There are wins and there are losses.
It sounds like a constant cycle then. Negotiation, renewal, always subject to government needs and, well, the political wins, maybe. Given these dynamics and the recent performance, what does the future outlook seem to suggest? What are the potential catalysts, maybe for growth, or the looming risks?
Well, potential positive catalysts mentioned include, naturally, upcoming earnings reports. If they continue showing strong performance, that could build on the Q1 results.
Keep the momentum going.
Right. And the possibility of further expanding contracts with ICE, especially given the operational adjustments they've made, that's seen as a potential positive. Continued focus on those reentry programs and corporate responsibility initiatives are also noted as factors that could maybe influence their standing.
And the risks. Are they pretty much the same ones we've already been talking about? Pretty much, yes. The risks are largely the inverse of the catalysts and drivers we just discussed. Adverse regulatory changes are top of the list. Shifts in market conditions that affect government spending priorities is another big one. And, of course, negative outcomes from contract renewals or new bids.
Makes sense.
And you also have macroeconomic factors, things like changes in interest rates, which can play a role. They impact financing costs, especially for a company holding significant physical assets like CoreCivic does.
Right, affects their borrowing costs. Now, on the financial analysis side, the material mentioned that certain key metrics weren't available. What kind of metrics are typically missing in a high-level snapshot like this? And why are they important for getting the full financial picture?
That's a good point. The material notes that figures like debt-to-equity ratio, free cash flow, return on equity, price-to-book ratio, and beta, those weren't provided.
Okay, quite a few missing pieces.
And these metrics are pretty crucial for a more complete financial health and valuation assessment.
Can you just briefly explain what those tell an investor? Like debt to equity.
Certainly. Debt to equity gives you a sense of leverage, how much debt the company is using compared to shareholder equity. Free cash flow is critical because it shows the actual cash the business generated after paying for its capital expenditures. It's often seen as a truer measure of financial health than just net income.
Okay, the real cash coming in.
Exactly. Return on equity measures how effectively they're using shareholder investments to generate profits. Price to book compares the market value to the company's accounting book value, a different valuation perspective than, say, the PE ratio, which was mentioned as being around 37.1x.
Right, we had the PE.
And beta measures the stock's volatility relative to the overall market, how much riskier or less risky it is compared to the average stock. So without these, you get a snapshot of recent performance, like that strong Q1, but less insight into the long-term financial structure, efficiency, cash generation, or relative risk profile.
That makes perfect sense. A few headline numbers are useful, absolutely, but these other metrics provide the scaffolding for understanding the company's fundamental strength and how it's valued by the market. So given those strong Q1 numbers, the improved occupancy, and the mix of contract news, how has the market reacted recently? The material mentioned the stock price rose after that Q1 beat.
Well, the positive Q1 results, particularly the significant beat on revenue and especially EPS, plus the increase in occupancy that was certainly received well by the market.
Understandably.
Those performance indicators, combined with the recent contract announcements, likely contributed to a more positive sentiment and probably drove the recent movement we saw in the stock price. Markets often react quite strongly when companies exceed expectations, particularly on key profitability metrics like EPS.
And based on the available data that was analyzed, was there an overall view or like a recommendation provided?
Based on the analysis within the material, the summary view leaned towards a hold recommendation for investors.
A hold.
The rationale seems to be that while the recent financial performance shows definite strength and the company operates with relatively stable government-backed revenue streams, those inherent regulatory risks, the policy sensitivity, and the public perception challenges are significant factors that warrant caution.
So not quite a buy because of the risks, but not a sell because of the performance.
That seems to be the thinking behind it. It's not necessarily a strong buy because of those uncertainties, but the recent performance in the existing contract base suggests it's not necessarily a sell either. So it lands in that middle ground hold territory.
Okay, we've covered a lot of ground here. CoreCivic's business model really centered on those government contracts. The details of their strong Q1 2025 performance with key metrics like revenue, EPS, and occupancy all looking pretty good, exceeding expectations. We've also looked at their competitive landscape, who they're up against, their operational edge, and maybe most importantly, the significant external risks they face from government policy, regulation, and public perception.
That's right.
It's clear that while the company demonstrated solid operational execution and financial results in the most recent quarter, especially with those improvements in occupancy and beating forecasts, their future performance remains uniquely intertwined with the dynamic and, frankly, often unpredictable world of government decision-making and the evolving public sentiment around the industry they're in.
And this is where it gets really interesting when you step back and think about it. The material lays out this financial picture, showing how operational improvements and contract wins can translate directly into revenue and profit growth, driving, a positive market reaction. That's tangible.
Right.
But at the very same time, it highlights these major external forces, policies that could shift on a dime, regulations that could change, public opinion that could really influence government action, and those are largely outside the company's direct control. This tension, it raises a really important question, I think. For an investor looking at a company like CoreCivic, how do you balance that tangible data, the recent financial performance, the potential stability of government contracts? How do you weigh that against these less predictable, yet potentially very impactful forces of political will and societal views surrounding the whole private corrections industry?
It's a fascinating challenge to consider when evaluating a company like this, or really this whole sector. Something certainly worth mulling over as you look deeper. Thanks for joining us for this deep dive.